This is Brad Berry, Chief Investment Officer and Portfolio Manager with Dynamic Wealth Group. Welcome to this market and economic update. As everyone settles into their post-Labor Day routines, it's a good time for investors to reflect on market conditions and review their financial plans for the rest of the year. Despite some market volatility during the summer, major U.S. stock indices have all experienced significant gains this year. Bond markets have also shown improvement, with various bond indices posting gains year to date. A softening labor market and slowing inflation point to the first Fed rate cut later this year, and the shifts in the Treasury yield curve may have staved off recession expectations. All in all, the past few months are a reminder to not overreact to short-term market moves. This could be an important lesson in the coming months, with the presidential election approaching and with ongoing geopolitical risks. First, this chart shows annual returns for the S&P 500 represented by the dark blue bars and the Bloomberg U.S. Aggregate Bond Index total returns in the gold color. Major stock indices, including the S&P 500, have shown significant gains this year despite market volatility. This has occurred even though many expected a hard landing as the Fed raised rates. So far, there have been two periods of sustained pullback this year. In April and August, both instances experienced sudden market rebounds. Bond markets have also improved, showing positive returns year to date after struggling for much of the year as rates remained high. Expectations of an imminent rate cut have thus helped to boost returns. Next, this chart tracks the federal funds rate with the dotted lines indicating the FOMC's projections for rates based on the summary of economic projections they publish quarterly. With inflation now down to 2.5% in the latest PCE price index report, the Fed is now expected to issue its first rate cut in September. This is a reversal of the rapid rate hikes from early 2022 to July of 2023. Recent jobs data showed signs of softening, with unemployment rising to 4.3%, prompting the Fed to shift its focus from inflation to labor market concerns. So with inflation improving, the Fed is preparing to cut rates to ensure that the economy continues to stay on track. Many of this year's market swings have been the result of shifting expectations around the Fed. It's important to remember that investors believed the Fed would cut several times at the start of the year. Then, when inflation ran hotter than expected for a few months, investors believed the Fed would not cut rates at all this year. Now, expectations have shifted once again. This is a clear reminder that markets can get ahead of themselves, and it's important to not get swept up in the latest market move or headlines. Finally, this chart shows the Treasury yield curve at 3 points in time: the latest market day, the end of the previous quarter, and the end of the previous year. It shows that the yield curve has started to flatten and is no longer inverted when comparing the 2-year to the 10-year, as market-based interest rates adjust to approaching Fed rate cuts, with yields moving lower, especially on the short end. While yield curve inversion historically precede recessions, only time will tell if this could be different, as higher short-term yields resulted from inflation shocks rather than Fed over-tightening. Lower rates could be positive for economic growth, especially in rate-sensitive areas. We hope you found these high-level insights helpful. If you are a financial advisor and would like more information on our multidimensional approach towards asset management, feel free to download our eye-opening white paper titled Busting 7 Risk and Return Myths. Click the link below or visit our website at dynamicwg.com or email us at info@dynamicwg.com. If you are an individual investor, we are happy to address any questions you may have and put you in touch with a qualified advisor if so desired. Until next time, take care, everyone, and make smart, logical, and fact-based financial decisions.